SCHD is down hard in 2025, and you might be wondering if now is the time to sell. But here's the thing. Once you understand why it's down and what that means for the future, you'll probably look at this a little bit different. And I'm not going to waste your time. In this video, I'm going to show you exactly why it's down, how much further it might have to go, and what my plan is with SCHD. Because guys, we keep talking about a disciplined approach to investing as well as dollar cost averaging. So let's get right into it. Now guys, SCHD is a great way to own stocks that pay a high dividend. Right now, SCHD's dividend yield is 4.1%. That's a lot. Now, I don't want you to become one of those people who believes that dividend investing is this thing where you buy companies that pay a dividend and they're amazing. Guys, remember, dividends are tax inefficient and they should only be paid as literally probably the last resort for a company to do something with its cash. If a company has a very good way of reinvesting back in the business, when they pay a dividend, they're basically saying, we want to make the investors feel warm and fuzzy, as opposed to reinvesting in the business to grow the business's value. With that said, the reason it's part of my portfolio is because it hits the things that I need. I've got real estate upstairs. I've got 8 or 9 businesses that generate cash flow. And I don't need to hit home runs in every single stock I own. Do I still want to? Absolutely. But my goal here is to sit there and meet the needs that I have for the rest of my life. And SCHD can do that for me. But remember, my situation might be different. So let's go take a look at SCHD versus something like QQQ. QQQ is this exciting NASDAQ 100, tech-heavy, high returns on capital, blah, 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 ETF. It is awesome. And we have shown you guys how buying QQQ, even at the peak in 2000, if you dollar cost average, you still could have gotten 14% returns after watching it fall 80% at one point. That's huge. Why? Because QQQ consists of companies that have great balance sheets and don't require a lot of capital to keep growing. And when they do grow, they're able to grow their revenue and profit at much faster clips than normal, boring companies. So let's compare these two ETFs to see what's inside of them, and then also compare them to show you guys why QQQ is vastly underperforming SCHD, and my guess will probably underperform it for quite a while. So this is the top 25 holdings for SCHD. Coca-Cola, Verizon, ConocoPhillips, Altria, Lockheed Martin, PepsiCo, Home Depot, Chevron, Amgen, Cisco, Merck, Bristol-Myers, AbbVie, Guys, you see my point here? Which one of these is sexy as a sexy company? Not many of these, if any of them. Cisco was a sexy company back in 2000, and it's actually still below its 2000 peak. These are companies that probably don't have a ton of growth potential, but that are part of our life for a very long time. Now, let's compare that to QQQ. Ready? Apple, Microsoft, Nvidia, Amazon, Broadcom, Meta, Costco, Netflix, Google, Tesla, T-Mobile. Cisco's part of it. There you go. There's our first right here. PepsiCo and Cisco. Those are the first two I see they're mimicking. Palantir's in here. Adobe. Bookings Holdings, Amgen's in here. So that's 3 right now. I see 3 companies in the top 25 holdings for QQQ that match SCHD. Now, what do you notice about QQQ? Mag 7. Guys, how many times have we said it? The Mag 7 led stocks up, and we believe they'll lead stocks down. Whenever you have a small group of companies that just surge and really drive the valuations of the market and drive the price of the market, when those come back to reality, what happens to the overall market? It's going to go down along with it. And it's no coincidence that QQQ has underperformed the S&P 500 since the beginning of the year. Let me show you this. SCHD, year to date, down 7.43%, not including dividends. Down 7.43%. Now, let's pull up QQQ. Keep in mind, by the way, QQQ's dividend yield is about 0.6%. 10.5% down. Now you might sit there and say, that's not a lot. Well, we've also had a rebound recently. We've had quite the rebound as of late, and that's probably going to help QQQ more than SCHD. If you told me right now that QQQ is going to be up 20% from now to the end of the year, I'd probably say, all right, then SCHD is probably going to be up around 10%, maybe 8%. I don't know, because QQQ is comprised of the market movers right now. Now, let me show you guys valuations. This is the 8-pillar portfolio on the top 7 stocks in QQQ. Great ROIC. This means the companies can reinvest money back in their business and really drive profit. This deserves a premium. Revenue growth, income growth, shares outstanding are about even, low debt, high cash flow growth. But look at these. 50 times last 5 years earnings, 57 times last 5 years free cash flow. Now, as I said, they deserve a premium. These companies are very, very good companies. They deserve a premium. But let's go see these valuations for SCHD. This is SCHD. 19 times earnings, 22 times free cash flow. 60% lower valuations. 60% lower. Higher debt, but cash flow growth, revenue growth, net income. And good return on invested capital, higher than the market. But again, not quite as QQQ. Does that mean you should avoid QQQ? No. It just means right now, in my opinion, valuations do not look good for QQQ. But I assure you, with beyond a certainty of doubt, that I will own QQQ and I will dollar cost average into QQQ at some point. Right now, I'm just doing it with SCHD. It fits my needs, so you have to make sure it fits your needs before you do it. So now, with SCHD, it's paying that 4.1% dividend. But of course, I sell covered calls in my holdings to add a few more percentage points to that. Now you might sit there and say, you can really add a few more percentage points of income to your portfolio? Absolutely. It's called selling covered calls. And this is something that anybody and everyone should learn. Whether you have the holdings to do it today, even if you don't, you got to learn it now. Because there's a way of selling what's called the poor man's covered call if you don't have quite 100 shares. But for the future, when you retire, this is money that can help you live and grow your wealth as you go into retirement, and could even potentially double or triple the amount of money you have in retirement. That's not a gimmick, and it doesn't come without its issues and its concerns and the problems that people run into. But let me show you what I do. So SCHD is currently selling for around $25 a share. When I sell a covered call, what that does is I'm selling somebody the right to come take the shares away from me at a price that's higher in the future. So for example, if I'm sitting there saying, okay, from a month from now, I want to sell a $27 covered call. And let's say the market's willing to pay me 10 cents. You might sit there and say, well, that's nothing. Well, it might seem like nothing, but it's actually quite a bit. It's 0.33% for 1 month. You multiply this by 12, and that's 4% extra of income. Now, what are the risks? Well, the risks are very simple. If SCHD goes above $27 a share, you keep your 10 cents, you make all your gains from 25 to 27, but everything above that, you don't get, okay? So you're basically sacrificing future gains. So it's very, very important that you don't sit there and just use this purely for income and sell like 25, 50 covered calls to get high income, because you could very well lose the shares. And this is a very important strategy that, if used properly, can add 2 to 4% per year to your returns. Now, also, SCHD, being such a big ETF, you're not going to generate as much money from it because the volatility is not big, versus another company that you might own individually that you can generate a ton of return off of. This is just an example of adding 4% return if you're able to keep doing this over and over and over again and not lose your shares. And you guys remember, 4% a year. Every 17 or 18 years will double your money. So if you're in your early 30s and you're looking at retiring at 65, this could literally 3x, triple the amount of money you have in retirement. And if you have that money in a 401k or IRA that grows tax-free, that's going to grow tax-free all along the way. So if you want to learn more about this, I truly believe it's something that every investor needs to understand. So guys, I want to make this very, very easy for you. If you want to learn more about this, I have a free PDF. Click the link below. I will email it to you immediately upon you entering your email, and it'll explain very easily covered calls and something else called cash secured puts. Now guys, if you're someone who likes learning about SCHD or QQQ, you're also probably the kind of person who wants to build real, true wealth. But here's the truth. SCHD is just one piece of the puzzle. I go on Twitter and I see people talking about dividend investing like it's some amazing, and it is. It can be very incredible, but it is sacrificing for the future. To become a confident, principle-driven investor, you need to understand the reason behind every investment, not just follow a name or some dividend yield. That's why we created our full stock investing course. It isn't about hype. It's not about getting rich quick. It's about mastering the mindset, the math, the method to invest with logic, discipline, and confidence, and more importantly, the emotional side of investing, just like we do. So click the video on the screen and you'll never look at the stock market the same way again. Thank you for your time.